Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hammond, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're starting with some concerning news about the Canadian housing market. The latest data from the Terranet National Bank House Price Index shows that Canada's housing market continued to soften in April, with home prices declining for a fourth consecutive month. The National Composite Index dropped by 1.5% month over month.
That's right, Steve. It seems like economic uncertainty and the ongoing United States trade dispute are really taking a toll on buyer confidence and stalling the resale market. It's disheartening to see how these larger economic factors trickle down to affect individual buyers and sellers.
Absolutely, Janine. The report highlights that since December 2024, house prices have fallen by 2.4%. Both condominiums and single-family homes have been affected, with condo values declining 2.7% and single-family homes dropping 2.1%. This downturn is becoming more widespread, with 68% of monitored cities experiencing monthly price decreases in April.
And it's particularly striking how Ontario is bearing the brunt of this downturn. The report notes that 75% of Ontario's covered markets have seen declines of 10% or more from their peak levels. That's quite significant compared to just 27% of other Canadian markets experiencing similar declines.
Indeed, Janine. In Ontario's largest markets, the decline is even more pronounced. For instance, Toronto saw prices fall 2.7% in April, a noticeable increase from the 1.3% decline in March. Hamilton's prices slid 3.9%, and Ottawa-Gatineau registered a 1.0% drop. These numbers indicate a clear acceleration in price declines.
It's a challenging situation, Steve. The report also emphasizes that broader macroeconomic headwinds, such as elevated long-term interest rates and moderate population growth, are weighing on market sentiment. It seems like the outlook for Canadian home prices might remain bearish for a while.
Yes, the report suggests that with ongoing economic uncertainty and the risk that long-term interest rates might stay higher for longer, home prices could remain under pressure in the coming months. It's crucial for buyers and sellers to stay informed and be strategic in their decisions during these times. Let's shift our focus to some positive developments from the Canada Mortgage and Housing Corporation. They've reported a notable 2.4% increase in housing starts for April, bringing the total to 240,905 units. This is a promising sign of growth, especially in certain parts of the country.
That's right, Steve. The trend measure, which is a 6-month moving average, highlights increased activity in Quebec and the Prairie provinces. It's heartening to see these areas thriving, especially with all the economic uncertainty we're facing.
Absolutely, Janine. However, it's important to note that Ontario and British Columbia saw declines in housing starts on a year-over-year basis. Kevin Hughes, the deputy chief economist at CMHC, mentioned that the increased starts activity was primarily driven by Quebec and the Prairies. It seems like those regions are carrying the torch right now.
Yes, and while it's concerning to see declines in Ontario and British Columbia, it's crucial to remember that economic uncertainty will have consequences for the supply and demand of new housing. CMHC plans to closely monitor these effects over the coming months.
Indeed, Janine. Key statistics from the report show a 30% monthly seasonally adjusted annual rate increase in April, which amounts to 278,606 units. This is significant, considering actual housing starts in centers with populations above 10,000 reached 21,720 units, marking a 17% year-over-year rise and setting a record for April.
That's remarkable, Steve. Montreal, in particular, experienced a 64% increase in starts, largely driven by multi-unit projects. It's really encouraging to see such growth in housing development, especially in a city like Montreal where housing demand is high.
On the flip side, Toronto reported a 25% decline in housing starts compared to April 2024. This is a stark contrast to the growth seen in other major cities. It highlights the varying dynamics across different regions in Canada.
It's a mixed bag, Steve. While some cities are seeing growth, others are facing challenges. But with the right strategies and support, I believe there's potential for improvement across the board. It's vital for us to stay informed and adapt to these changes in the housing market.
Janine, today we're diving into a rather unsettling story about a significant legal development in the Ontario real estate market. The Home Construction Regulatory Authority has charged a developer for the illegal sale of 453 pre-construction homes across the Greater Toronto Area. This involves 7 companies operating under Stateview Homes and the firm's 3 senior executives.
That's quite a serious situation, Steve. It really highlights the importance of regulatory compliance in the home building industry. Before a builder can sell a new home in Ontario, they must obtain a license from the Home Construction Regulatory Authority and receive approval from Tarion. Without these, any sale is deemed illegal.
Exactly, Janine. Compliance isn't optional, as Wendy Moyer, the Chief Executive Officer and Registrar of the Home Construction Regulatory Authority, emphasized. Builders who fail to meet these obligations are operating outside the law, and the regulatory body is taking strong enforcement actions as a result.
It's a cautionary tale for both developers and buyers. An investigation by the Star found that Stateview Homes collected tens of millions of dollars in deposits for homes they weren't authorized to sell. It's particularly alarming that in some cases, deposits were solicited for homes on land the company didn't even own.
That's right, Janine. And now, the 3 senior executives, including the Tarasi brothers who led the company, face charges for failing to take reasonable care to prevent these violations. The scale of alleged violations and the financial harm to buyers has prompted the regulator to pursue these charges.
It's heartbreaking for the hundreds of homebuyers left without the homes they expected and without the substantial sums they paid in deposits. Many of these buyers are now turning to Tarion, the protection agency for new home buyers in Ontario, to seek compensation for their lost deposits.
And there's a new rule coming into effect that might complicate things further for homebuyers. Starting July 1st, purchasers of new freehold homes are required to notify Tarion within 45 days of entering into a purchase agreement. Failing to do so could result in reduced deposit coverage if issues arise with their development.
Yes, while the intent is to identify illegal sales earlier, consumer advocates argue that this approach might end up punishing the buyers instead of catching rogue developers more effectively. They believe regulators should focus more on policing the industry to prevent such issues from occurring in the first place.
It's a complex issue, Janine, balancing the need for regulatory oversight with consumer protection. The real estate market is critical to our economy, and ensuring its integrity is paramount. This case is a stark reminder of the vigilance required to safeguard both the industry and consumers.
Absolutely, Steve. It's essential for everyone involved in the real estate market to stay informed and proactive. While the legal proceedings unfold, it's a time for reflection and learning for the industry as a whole.
In Canada's residential mortgage market, we're witnessing a fascinating dynamic where the big banks are essentially up against everyone else. Residential mortgages are a significant part of bank lending, accounting for nearly half of all loans. This asset class offers financial institutions both security and stable returns, with banks currently earning an average return of about 1.5% on the money they lend.
It's interesting, Steve. Residential mortgages are backed by home collateral, mortgage default insurance, and a stable housing market, making them among the lowest risk lending options. This low risk makes the mortgage market one of the most competitive arenas in Canadian banking.
Absolutely, Janine. When we look at market share, it's crucial to differentiate between origination and ownership. Mortgage finance companies like First National and MCAP originate about 10% of residential mortgages in Canada. However, they rarely keep these loans on their balance sheets, often selling them to larger institutions, such as the Big Six banks.
And that's where the big banks have a significant advantage. They not only dominate origination, but also control a much larger share of ownership. As of January, outstanding residential mortgage credit was around $2.07 trillion, with more than $350 billion in additional home equity lines of credit. This brings total residential real estate secured lending in Canada to $2.42 trillion.
Exactly. The Royal Bank of Canada leads all lenders with a 19.8% share of real estate secured loans. Combined, the six biggest banks control around 74% of the market, and if you include Desjardins, it goes up to 80%. The remaining 20% is shared among smaller banks, credit unions, and mortgage finance companies.
That's a tight squeeze for smaller players, Steve. They try to stay competitive by offering lower mortgage rates or by serving niche borrowers with non-traditional income or credit profiles. However, their market share has declined slightly over the past decade.
Yes, Janine. Back in January 2015, non-Big Seven lenders held 21.5% of the market. By 2025, that figure had dropped to 20%. This trend highlights the structural challenges facing smaller institutions, like limited brand recognition and restricted distribution channels, not to mention the scale and customer loyalty commanded by the dominant banks.
It's a tough market to crack, Steve, but it's important to remember that these smaller institutions often play a vital role in serving the needs of borrowers who might not fit into the traditional mold. Their presence encourages competitive rates and innovation in the mortgage industry.
Today, we're turning our attention to the Canadian currency market, where the Canadian dollar has seen a modest rise. The Bank of Canada recently decided to hold its interest rate steady at 2.75%, which defied expectations for a rate cut amid cooling inflation. This decision has shifted investor sentiment and led to a 0.2% gain for the Canadian dollar against the US dollar.
Yes, Steve. It's interesting because while the annual inflation rate in Canada fell to 1.7% in April, the core inflation measures are still above 3%. This has led the Bank of Canada to pause rate cuts for the first time since last June, and it seems to have caught investors by surprise. The probability of a rate cut at the next meeting has now decreased significantly from 65% to just 33%.
That's a significant shift, Janine. The broader economic context is also playing a role here. The US dollar has been declining against global currencies, partly due to a cautious stance from the Federal Reserve and a recent drop in oil prices, which is a key Canadian export. These factors are adding layers of complexity to the economic landscape.
Absolutely, Steve. And with rising Canadian government bond yields, particularly the 10-year benchmark's increase of 11.6 basis points, we're seeing evolving market views on inflation and economic stability. Investors might need to rethink their strategies as the bond market reflects these reduced expectations for immediate rate cuts.
Indeed, Janine. The Bank of Canada's steady stance contrasts with the cautious approach of the US Federal Reserve and changing global economic conditions. This interconnectedness of global markets influences everything from currency values to international trade strategies, highlighting the importance of staying informed.
It's a reminder of how interconnected our economies are, Steve. These dynamics are crucial for investors to understand as they navigate the shifting tides of the financial markets. The Canadian dollar's strength, in this case, reflects a complex interplay of domestic and international factors that we need to keep an eye on.
Janine, the Canada Mortgage and Housing Corporation recently unveiled the 25th edition of their Mortgage Consumer Survey, and it's offering some intriguing insights into the behavior and attitudes of Canadian homebuyers in 2025.
That's right, Steve. It's fascinating to see how the landscape is evolving, especially with more first-time homebuyers entering the market. The survey found that about 60% of these new entrants relied on mortgage loan insurance, which highlights the challenges and opportunities for those taking their first steps into homeownership.
Absolutely, Janine. The survey showed that many Canadians are feeling financially ready to buy, with the average time to save for a down payment decreasing from 4.2 years to 3.4 years. This suggests that prospective buyers are becoming more proactive in preparing for home ownership.
And that's encouraging, Steve. It's heartening to see that despite the challenges, people are finding ways to enter the market. The survey also noted that gifted money played a significant role, with home buyers receiving an average of $80,000 to help with their down payments. In high-cost areas like Ontario and British Columbia, this amount could be as high as $150,000.
Yes, and while it's great to see people getting into homes, it's important to note that about half of the mortgage consumers stretched their budgets to the max. This raises concerns about financial stability, especially if economic conditions change.
That's a valid point, Steve. The survey also revealed that 62% of homebuyers felt some level of uncertainty during the homeownership process. This underscores the emotional and financial stress involved, which is something we, as mortgage professionals, must be mindful of when advising clients.
And speaking of financial strategies, the survey highlighted a trend toward energy-efficient renovations. Over 55% of homeowners completed renovations in the past 3 years, and 75% plan to do so in the next 5 years. This shift not only boosts property value, but also reduces energy costs, with 80% of those who made improvements reporting savings on their energy bills.
It's wonderful to see homeowners investing in energy efficiency, Steve. The satisfaction rate was remarkably high at 93% for those who completed such renovations. This indicates a growing awareness and appreciation for eco-friendly living, which is a positive trend for the environment and homeowners' wallets alike.
Another interesting finding was the change in how consumers gather mortgage information. While websites remain the top source, social media usage has surged, with YouTube overtaking Facebook as the leading platform. This shift is driven largely by younger audiences and first-time homebuyers, showing a clear trend towards digital channels for advice and insights.
That's an exciting development, Steve. It shows how the digital landscape is transforming the way people approach major financial decisions. As mortgage professionals, we need to adapt to these changes and ensure we're reaching clients where they are most comfortable seeking information.
Indeed, Janine. It's crucial for us to stay ahead of these trends and continue providing valuable resources and guidance to our clients. The CMHC's Mortgage Consumer Survey offers a wealth of data that can help us better understand and serve the needs of Canadian homebuyers. Today, we're wrapping up our episode with a focus on Ontario's cottage market, where recent events have created a unique opportunity for both buyers and sellers. A spring ice storm, coupled with federal and provincial elections and even a trade war with the United States, have delayed the start of the traditional spring selling season in Ontario's cottage country.
That's right, Steve. The Victoria Day long weekend offered a chance for the market to reset as new listings began to emerge and out-of-town buyers headed north to regions like Muskoka, Georgian Bay, Haliburton, and the Kawartha Lakes. It seems like this year's market is shaping up to be quite different from the frantic pace we saw during the pandemic.
Indeed, Janine. Anita Latner, a broker in Muskoka, mentioned that the recent weather events were some of the most devastating they've experienced, causing power outages and downed trees that wreaked havoc in the area. As listings start to appear, buyers are being more cautious given the economic uncertainty and volatile financial markets.
And it seems buyers are taking their time, Steve. Anita Latner pointed out that it's a buyer's market now, reminiscent of pre-pandemic days when people could afford to be patient. She emphasized the importance of setting realistic asking prices as the days of inflated prices seem to be behind us.
Jeff Strano, a real estate agent in Haliburton, noted that many cottage owners were busy assessing damage and cleaning up debris, which delayed their plans to list properties. However, inventory surged in early May as cottages were prepped and election campaigns wrapped up. Yet, buyer demand is still lagging behind listing demand.
That's right, Steve. Jeff Strano mentioned that potential buyers are waiting for prices to drop before making a move. He observed that the region had 156 waterfront properties for sale leading up to the Victoria Day weekend, compared to 126 last year. Despite the increase in listings, there was a 29.4% drop in waterfront property sales compared to 2024.
The average cottage sale price year to date is $988,600, which is a slight dip from last year. The average days on market has increased significantly, leading some sellers to become more willing to negotiate on price. Buyers now have more choices and can make offers with conditions, such as home inspections and securing financing, which was less common during the pandemic.
That's a positive shift for buyers, Steve. The increased inventory and longer days on market mean buyers can strike better deals. Jeff Strano also pointed out that there's a window now to purchase properties at about 15 to 20% below the 2022 peak, offering a more balanced market environment.
Leah Zlatkin, a mortgage broker, noted that many cottage buyers are less affected by economic anxiety because they're often using set-aside funds rather than seeking financing. However, those who need a mortgage sometimes plan to rent out the cottage to help with costs, a strategy that's becoming more challenging due to tighter municipal regulations on short-term rentals.
It's an evolving market, Steve. While some believe prices have been inflated for years, Jeff Strano cautioned that a major crash or correction may not be on the horizon. He remains optimistic, suggesting that sales could pick up in the second half of the year if trade tensions ease.
Paul Crammon from Muskoka highlighted that many sellers are longtime cottagers who are selling due to life changes rather than financial necessity. This means there's often less urgency to sell quickly, leading to a more stable market.
Yes, and with the prime lakes having limited supply, it's not uncommon for cottages to take longer to sell. But as the season progresses, we could see more activity as both listings and sales pick up pace.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.